Hi, and welcome to The Full Perspective. I'm Charlie Thomas, Content Director for the Insurance Insider, and each week I'm going to be talking to some of Insider Publishing's senior staff to dig into the week's most interesting stories. This week I'm joined by Trading Risks Managing Editor Fiona Robertson. Hi, Fiona.
Hi, Charlie.
And Insurance Insider's Managing Editor Katrin Chi.
Hi, Charlie. Thanks for having me.
It's all right. Thanks for being with us, guys. We are going to start by looking at the D&O market this week. It's been quite the week for the class, with news that carriers are preparing for a $600 million loss for claims against drug manufacturer Teva Pharmaceuticals. That news broke earlier this week. Katrin, give us a rundown of the key developments for anyone who missed it.
Sure. So, this Teva loss has actually been on the horizon for a while for the D&O market, as is the case with lots of long-tail claims. But it's only kind of come into the news agenda this week because carriers have been told to fully reserve for a total loss on the 600 million of limit that is on the 2016 underwriting year. Now, 2016 was when Teva was stung by both a securities class action in the US and a derivatives action in Israel over alleged pricing collusion. The firm is actually dual listed in Tel Aviv and in New York. Basically, this has kind of hit the market this week, and everyone has kind of been talking about it, and it's come at a time, when the D&O market is really hurting. Underwriters are trying to push rates really hard in order to compensate for the strings of losses they've been having, which has obviously also been amplified by social inflation trends in the US. And also there are concerns that the class is under-reserved. So that's kind of on the radar. And then also this week, you will have seen the wider press through June about all the scandals that are going on with Wirecard, and that is also set to be a loss to the D&O market. We understand they do buy cover, but the details aren't quite out there yet. But actually, the Wirecard situation will result in a multiple clash loss across lots of financial and professional lines. So you've got D&O, Wirecard may also buy professional indemnity, a crime policy, you've got the trade credit policies associated with all the banks that will claim for non-payment, and also there's professional indemnity and potentially errors and omissions for EY, who are the auditing firm that kind of signed off on Wirecard's accounts all the way up until now, and then all of a sudden there's kind of a multi-billion hole in their accounts, which has obviously caused the company to go into insolvency. So really, it's this narrative of just loss after loss after loss on these liability lines, which were already hurting, and they were already, trying to push rate and regain ground really after years of soft market pricing.
Mm-hmm. So really painful for D&O, as you've mentioned. Is there a wider read across for the broader sort of FinPro classes, though?
The thing is this with the other FinPro classes, as I said, PI and E&O, for example, they're all kind of in a similar situation where it comes to sort of growing claims frequency and severity as a result of social inflation. And they also were victim of kind of multiple years of compounding rate reductions. So the actual technical adequacy on the rate that they're getting there isn't very good at all. So they don't really have the buffer to absorb this sort of magnitude of loss. It's going to be interesting times for those classes, I think.
Are we hearing anything, or it might be too early, I'm guessing, but are we hearing anything in terms of market exits or people scaling back their participations, anything like that, given the state of the market?
I think people are being more cautious, definitely. From what we hear sort of anecdotally, that it's harder to get capacity together for a tower, particularly in D&O, for example. People putting out smaller line sizes, maybe ventilating through towers, kind of pushing hard on the terms and conditions as well. And that's kind of a sign that people are really trying to rein in their exposure in order to manage that profitability.
What's interesting to me about it as well is that you're talking about a 2016 claim here for Teva. Not so for Wirecard, although maybe it's interesting to try and think about which year's covers will be responding for people like EY. I don't know whether it's automatically this year or all the prior years when they were auditing Wirecard, but this could be what we're in for from COVID maybe as well, that it won't be until 2 or 3 years down the line that some of the losses on your side of the market start showing up.
Yeah, definitely. And I think, someone gave me a really good line from the FinPro world who said that, a recession is like a FinPro hurricane. So obviously when COVID is likely to trigger a deep recession. And it's in that recessionary environment where all the bad actors come out, all the skeletons come out of the closet, and everyone starts suing each other, and there's loads of legal action, of course, the cost of which gets passed on to the FinPro market. So, I think that is also part of the driver for underwriters to push for rate, because they're almost preempting that it's going to get pretty ugly from here on in.
Yeah, I wonder whether a better analogy rather than a hurricane is more like a wildfire, because it seems to me that that sort of loss is something that goes sideways and there's no clear binary beginning and end, necessarily for some of these events. But yeah, that's going to be fun to watch.
Yeah, definitely. We'll have to keep an eye on it.
Okay, great, thank you. The second area I'm keen to delve into this week is the cracking scoop from Trading Risk, which is the news that the former Hiscox ILS COO Richard Lowther and ex-Alpha Cat CEO Li Jing, you're going to correct my pronunciation on this, Fiona. Is it Li Jing Zhang?
Yes, pretty close. I think it's Legion, but
Okay, thank you.
I hope I'm getting it right myself.
Are launching a new startup, Integral ILS, which has set up agreements with Transre and Amwins to grant it access to reinsurance business. So not often we get to write about brand new ILS. Fiona, tell us all the details.
Yeah, well, really looking forward to seeing what comes of it. The Legion and Richard have both had a high profile in the market, so I think everybody's been waiting to see. Richard in particular has been out of the market for quite a while and has kept everybody guessing with what he's going to be up to. So it's still early days. They, as far as we understand, don't have any investor money, so are not ready to start underwriting. They don't have capacity to bring to the market. But from what we have picked up, there are relationships that they've put in place to be able to access business. So the two key relationships that we've uncovered are with Amwins and Transre, who have set up partnerships so that once they have money in the door, Integral ILS, as it's called, will be able to easily access risk. And I think that what's interesting to me about that is that you just always see the kind of ILS model evolve. Some people want to tie up with the distribution that can get them to the investor side of the market, but here they're prioritizing the distribution to get access to risk and get leverage. And yet, from what we understand, a significant part of the kind of play to investors is going to be that they are independent of those two entities. So both Lowther and Zeng have come out of the in-house, fully homegrown reinsurer ILS models, where some argue that you have more conflicts of interest than an independent ILS manager, although a lot of ILS managers have been since acquired by reinsurers anyway. So I think it's just interesting to see that slight spin on the model every time you get a new ILS launch.
Mm-hmm. And this is going to be property cat focused, I'm guessing?
Yes, you're right. Yeah, so property catastrophe. So traditional ILS in that sense, and perhaps just a different setup.
Okay, that's great. Okay, and in terms of you talked about how they were going to be able to get to access to risk quickly. I think it's an interesting debate to have about whether ILS is still the fastest route to market. We have so many conversations about how Bermuda is faster than London, and when it comes to getting projects off the ground, that alternative capital seems to be a quicker route in for capital. But given that there's no capital here yet, I guess it remains to be seen, right?
Yeah, I think that's a really good point, because when people are talking about if we're going to get a class of 20, so far most of the speculation is centered on more traditional rated, either new startups, or you get people fundraising for things like Starstone, rebooted rated platforms. And I think that's partly reflective of the fact that COVID is kind of a long tail potential loss. So people see the opportunity in, say, that US E&S specialty markets, and for that you want rated paper and leverage. But I think it's also reflective of the fact that it has been a hard time to fundraise on the ILS side of the market. There've been back-to-back years of losses. COVID has sort of put a halt on being able to travel and do the in-person due diligence that investors expect to be able to do. So yeah, it's not going to be an easy road ahead of the vehicle. So arguably it does call into question what the fastest way to market is.
That's an interesting point about not being able to physically go and do the due dil, and that becoming a hurdle in this sort of post-COVID-19 era. I hadn't appreciated that. That's interesting. Mm-hmm. Okay, great. Any other headlines to catch your eye this week, Fiona?
Yes. Well, we are now into July, 2020 just racing by in lockdown, unfortunately. And with 1 July, it's a renewals period, not one of the major ones, arguably, but we have seen the release of the 1/7 first review report from Willis, which covered off their view on the renewals. And I think that one thing that I found interesting in covering that was we spoke to one of the brokers there, James Vickers, who told me that while the market is very much moving towards pandemic exclusions, it's been done in slightly a bespoke way. So he described it as having a library of 183 exclusions with slightly different wordings. And it did just make me wonder, it's great that reinsurers are tightening up on terms and conditions, but possibly for the future, is that kind of variety just opening up another sort of can of worms? I'm not sure. So we shall see.
How about you, Catherine? What caught your eye this week?
Oh, there's a couple. So I'm going to race through three, I think. So the first is the AGCS Allianz Global Corporate and Specialty overhaul. They've been the thorn in the side of the wider Allianz group, which generally is a very good performer for a while, successive underwriting losses. And it actually looks like the new CEO who came in recently has now just kind of devised the strategy. It's going to go ahead, big cost cutting, dropping premium fund forming business, buying more insurance, take out volatility. And we've kind of seen parallels here with other kind of big balance sheet insurers with specialty arms like Swiss Re Corporate Solutions, for example. You could argue AXA XL has also been trying to take volatility out, as has AIG. So kind of a bit of a trend there, but also AGCS has been underperforming for a while. Second would probably be Lloyd's response to pandemic risk and also any future systemic risks. They've come out of the white paper with 3 proposals as to how to tackle non-damage BI, right, for the medium term and the long term and the short term, even all the way through. So it's Restart, Recovery, and Black Swan Re, all of which kind of involve differing levels of government support, but they're open frameworks that anyone can go and run with. And basically Lloyd's is just trying to facilitate the conversation and get something done, which is I think a great response. And then the final one is a paper put together by the African Caribbean Insurance Network, which has included 6 steps to racial inclusivity in the London market, which has been backed by Lloyd's CEO John Neal and also by TMK CEO Brad Irick. Basically, they've done a big canvas of Black professionals in the market, and they've come up with these 6 concrete, actionable steps that companies can take. And I think, after all the conversation, after Black Lives Matter and people really trying to raise awareness of experiences of Black people in society, this is like a really tangible, concrete thing that companies can do. And I'd urge everyone to go and read the paper, as it's really interesting reading, and also, a great kind of call to action from the network.
It shows a great sense of leadership from both Eric and from John Neal, I think. And I think the thing that I am most intrigued to see the outcome of is, as part of this, the ACIN is launching its first comprehensive study of ethnic employment within the marketplace, right? And it's the first time that I'm aware of, anyway, that anyone in our sector has tried to quantify that in a meaningful way. And we've talked both through Insider Progress and also on Insurance Insider about some of the fear around collecting data in that way, and whether the employees feel empowered to give that data in the first place and what will be done with it. So there's a lot of lessons to be learned on that process, I'm sure, but it's good that they're taking steps there.
On that note, I do need to give a shout out to Zurich, who published their first ethnicity pay gap today. So it's happening. The ball is rolling.
Good. Well, hopefully they'll be the first of many. That's fantastic news.
Exactly.
Here. Good. Well, look, I'm afraid that is all we've got time for today. That has raced away today, ladies. Thank you so much for joining me. And thank you guys at home for watching as well. Until next time, stay well, keep safe, and we hope you will join us again for another episode of The Full Perspective.